So if you were just, watching the financial news as 2025 was wrapping up the headlines, well, they painted a picture of pretty broad success.
Yeah, it looked great on the surface.
Totally. The overall stock market, the S&P 500, climbed like a healthy 17% year to date, sitting near all-time highs.
Mm-hmm. And you had Bitcoin setting a new record.
A huge one. It temporarily shot above that massive $120,000 mark.
So it sounds like a classic rising tide event, right? You've got regulatory clarity finally, huge institutional interest, and the benchmark crypto asset is just setting records.
Yeah.
The expectation would be, that every company, even remotely connected to this ecosystem, should have had an amazing year.
And that right there is the great paradox we are going to unpack today.
The disconnect.
Exactly. Because while that macro picture looked brilliant, the key underlying assets were soft or even sinking.
Right.
Bitcoin, despite hitting that $120,000 peak, actually finished the year down about 4%, and Ether fell about 8%.
So we have record highs in the stock market, we have regulatory certainty, yet the foundation assets themselves are flat or even retreating.
But that's only half the story.
Right, because at the same time, some of these U.S.-traded crypto-related stocks just absolutely exploded. I mean, soaring 200%, 300%.
Or even 345%. And then on the flip side, you had others that were just utterly crushed, plummeting 40, 67, or even 88%.
Wow.
The difference between the winners and the losers was just staggering. We're talking hundreds of percentage points. The market wasn't just differentiating on, say, management quality. This
is extreme prejudice. It was a verdict against entire business models.
Exactly. It forces us to ask, what specific, measurable strategic pivots or events created this colossal divergence?
Because if the underlying crypto price isn't the primary driver anymore, something fundamental has really changed in how the market values these companies.
That's our mission today. To explore the specific decisions, the political shifts, the technological pivots that turned what looked like a pretty benign market environment into a brutal competition, one that rewarded strategic flexibility over pure asset accumulation.
All right, let's do it.
Okay, so let's unpack this and start with the context that was fueling all that optimism at the start of the year.
Yeah, the context was absolutely set for success. And I'd argue the political shifts were probably the biggest factor driving the mood of the market. It really injected fresh optimism into the whole narrative.
For sure. We saw the re-election of President Trump, and, whether you love or hate the politics of it, his administration's stance immediately added this undeniable political dimension to the BTC narrative.
It cemented its place in the political landscape.
It really did. And then came the tangible regulatory benefit.
And that's the critical difference from previous years, isn't it?
Mm-hmm.
The regulatory environment didn't just shift a little, it stabilized.
Mm-hmm.
We finally had the US SEC and the CFTC working in tandem to regulate digital assets instead of just, fighting for jurisdiction.
That successful collaborative approach is priceless for institutional adoption.
It is. And it led directly to real legislative victories, the big one, of course, being the passage of the Stablecoin Genius Act.
That gave the market so much certainty around digital currency backing and issuance. It was badly needed.
It was, although it wasn't all smooth sailing. We did have that whipsaw event in the spring.
Oh, right, the Liberation Day tariffs.
Exactly. That was a classic trade war shock. It caused a brief but very sharp sell-off across all financial markets. But the resilience was key.
Yeah, the markets recovered really quickly and were back at all-time highs by the fourth quarter.
What's fascinating to me is how quickly the market just absorbed those macro shocks. And I think that SEC and CFTC collaboration, it meant more than just stability. It actually enabled brand new investment vehicles.
Which is huge. We saw the debut of the first ever pure spot Solana and XRP exchange-traded funds.
And this is the proof, right? This is the proof of strong institutional integration. When you have major financial bodies greenlighting ETFs for assets beyond just Bitcoin and Ethereum, it signifies a really deep commitment to the space.
A huge vote of confidence.
Absolutely. And yet, despite all this regulatory wind at their backs, some stocks still just managed to fall right off a cliff.
So the macro stage was perfectly set. High Bitcoin prices, regulatory clarity, new products. But the stock market still decided to reward some companies wildly and punish others severely. Here's where it gets really interesting. The massive gains didn't come from optimizing the old model. They came from radically abandoning it.
It was a market that demanded creative destruction. That's really what it was. The investors decided that the physical assets associated with crypto, the power capacity, the cooling systems, the data centers, were actually vastly more valuable when pointed at a different industry altogether.
Let's start with the chart leader, BitMine Immersion. They soared an astonishing 345%.
Incredible.
And their success was rooted in a total transition away from Bitcoin mining. They became an ETH-focused treasury and staking company.
They executed a perfect pivot. Just a perfect pivot into a higher yield, more capital-efficient model.
Mm.
The company, which is chaired by Tom Lee, amassed almost 4 million ETH.
4 million?
Yeah, positioning itself as the largest corporate holder of Ethereum. They essentially transformed from a cyclical miner into a diversified yield generator.
And the stock price reflected that fundamental shift in, the quality of their revenue.
Absolutely. Then you have the AI pipeline.
Right. IREN Ltd, which used to be Iris Energy, was up 300%. They were known for sustainable mining, but their pivot was instant and total, a rapid shift into AI cloud infrastructure.
And this is the narrative that institutional investors really latched onto. The market was willing to completely re-rate these stocks as high-growth AI infrastructure plays. But we should pause here for a second, because even as their stock was exploding, JP Morgan issued a warning. They cautioned that this very rapid, very aggressive AI shift could strain IREN's balance sheet.
That's a crucial layer of caution for you to consider, for sure. High growth often comes with high risk.
And the market tends to overlook the balance sheet until it's way too late.
Still, the market loved that promise of stable, high-margin, predictable AI revenue. Take Cipher Mining, up 250%. They landed a massive $5.5 billion AWS AI deal.
And suddenly, the underlying infrastructure, the racks, the cooling, all that massive power input that was built for mining, it was instantly repriced as high-performance data center capacity.
It's a whole new valuation model.
It is. And this demand for AI infrastructure, it offers a huge advantage over mining. Earnings visibility.
Explain that.
Well, a data center lease provides long-dated, secured, recurring cash flows. That is inherently more valuable to a stable investment fund than the volatile, cyclical revenue you get from the price of Bitcoin or the difficulty of mining.
That makes perfect sense. And that AI HPC theme, it just ran through the entire winners list. Hut 8 Corp, up 136%. They sealed AI deals with major players like Anthropic and FluidStack, signed a massive $7 billion data center lease.
And the analysts loved it. Benchmark specifically highlighted that this secures those long-dated cash flows and dramatically improves that earnings visibility we were talking about.
TeraWulf, up 132%, followed the exact same blueprint. Expanded their AI push with a $9.5 billion Google-backed FluidStack joint venture.
And then they upsized a private offering to $900 million, specifically to fund data center expansion in Texas.
They aren't crypto miners anymore.
Not really. They're infrastructure developers whose original business model just happened to give them a competitive advantage in land, power, and high-performance cooling.
Even Bitfarms, a vertically integrated Canadian company, up a respectable 72%. They reported strong profits and immediately announced plans to convert their Washington site to handle AI and HPC workloads.
The writing was on the wall. If you had the physical assets, you shifted, and the market rewarded you for it.
And it wasn't just the physical infrastructure plays either. Retail platforms also thrived, but only if they diversified. Look at Robinhood Markets, up 208%.
Yeah, that's a fantastic retail success story.
Their crypto revenue didn't just inch up. It rose 300% to $268 million last quarter.
And that growth was driven by aggressively expanding beyond simple spot trading. They moved into new, higher margin revenue stream.
Exactly. Derivatives, tokenization, prediction markets. They diversified their crypto offering, just like the infrastructure companies diversified their physical assets.
Okay, so now, let's look at the flip side. We've established the macro environment was favorable. We had regulatory tailwinds, Bitcoin at $120,000. But so many companies, even the pioneers of the space, still saw these massive declines. So it raises a really important question. What specific strategies did the market penalize so heavily in 2025?
The losses were brutal. I mean, they signaled a total rejection of some previous market darlings. At the absolute bottom was Sol Strategies, which plummeted a massive 88%.
Wow. And this just highlights the peril of niche specialization. They had rebranded to focus specifically on Solana investment staking SOL tokens, investing in that ecosystem.
A pure play.
A pure play. And the market clearly punished that kind of hyper-specialization in a single altcoin, especially when that commitment was made right before the stock uplisted to NASDAQ, and then was immediately followed by the CEO stepping down.
Yeah, that doesn't look good. Investors want stability and breadth. not singular asset exposure with management turnover.
Another area the market really struggled with was these rewards and payments companies that just failed to capture new traction. Fold Holdings, they went public via a merger.
Right, their whole business is paying out Bitcoin cashback and rewards through their Visa card. They ended the year down 75%.
The market seems to have decided that pure rewards models are just too thin on margin, or maybe too slow on growth compared to the explosion happening in AI infrastructure.
They weren't a diversification play.
No, they were just a payments company with crypto focus. It wasn't enough.
We also saw struggles from major exchange players. Gemini Space Station, GEMI, ended the year down 67%, despite going public with a pretty substantial IPO in September.
And they were making moves. They won CFTC approval for a prediction market. They were planning expansion into futures and options, but the stock just could not gain momentum.
It seems like it was fighting against that prevailing sentiment favoring the AI narrative.
Then you have the really bizarre case of Semler Scientific, down 66%.
Yeah, a company known for, vascular disease diagnostic tools.
Exactly. And they suddenly pivot to become a large corporate holder of Bitcoin, only to get acquired in an all-stock deal by Vivek Ramaswamy's Strive.
It just showed that simply buying Bitcoin wasn't enough to sustain investor value. The core business needed to hold up on its own merits, too.
But the most shocking declines, I think, came from the pioneers of the Bitcoin treasury and mining model. Strategy Inc., MSTR, finished the year down a stunning 44%.
And that is the central shock of 2025, isn't it?
It has to be. I mean, this is the company that holds, what is it now, 671,268 BTC.
Far and away the largest digital asset treasury in the world.
And BTC briefly touched $120,000. How can the pure play accumulation strategy fail so spectacularly?
I think the market might have just reached a point of capital raise fatigue.
Explain that.
Well, Strategy Inc. is sticking to its pure accumulation strategy, right? They're targeting a massive $84 billion capital raise through 2027 via every offering imaginable equity, convertible notes, perpetual preferred stock.
So the market might be signaling.
We are tired of constantly being diluted to fund more Bitcoin purchases.
That's a fantastic distinction. The market isn't saying the Bitcoin itself is bad. It's saying the funding mechanism for pure accumulation is becoming unsustainable, or at least undesirable when you see these other more stable growth narratives.
And even Marathon Digital MRA Holdings finished the year down 40%.
And this is a company that posted a record $123 million profit in Q4.
Right. By pairing their BTC operations with new power and AI assets, they were trying to diversify, but the stock still finished deep in the red.
It really highlights that critical threshold we talked about. Simply dipping your toe into the AI waters wasn't enough. The market was demanding an absolute structural pivot. If your name still sounded like a Bitcoin miner, even if you were profitable and trying to diversify, you are likely penalized in favor of the companies who went all in on that high-growth AI infrastructure story.
So what does this all mean for you, the learner, trying to navigate this incredibly polarized space? I mean, the key takeaway from 2025 is just stark.
It is. The market heavily rewarded flexibility and diversification beyond pure Bitcoin exposure.
Absolutely. The massive triple-digit gains, they went specifically to companies that saw their physical assets, their power, their cooling, their data centers, not as Bitcoin infrastructure.
But as high-demand data center real estate.
Right.
Real estate for AI and high-performance computing, they successfully sold the market on a reliable, future-proof revenue model.
The contrast just couldn't be clearer. Even the Bitcoin-heavy pioneers and the profitable miners struggled significantly, which suggests the market is now demanding diversified, predictable revenue streams and these much higher growth narratives like AI and HPC infrastructure over simple asset accumulation.
It completely redefined what a successful crypto stock actually looks like. It shifted the entire narrative from HO dealing to active infrastructure monetization.
Yeah. 2025 was truly the year crypto infrastructure became AI infrastructure.
Without a doubt. The winners were those who moved the quickest. The ones who recognized that their competitive edge was in their physical infrastructure and their power delivery, not necessarily in the algorithms themselves.
And that leads us to a final provocative thought for you to consider.
Okay.
Given that the top performers of 2025 were the ones who successfully shifted their focus to AI infrastructure and ETH staking, while the largest pure-play Bitcoin treasury company on the planet, Strategy Inc., struggled despite record BTC prices. Is the market signaling a fundamental, maybe even permanent shift in how it values these digital asset companies? Is it moving away from the pure asset play and towards valuing businesses based on their ability to monetize their infrastructure and technologically diversify.
Something to chew on as the demands of Wall Street continue to clash with the original ethos of crypto accumulation.
We will see you next time for the next deep dive.